Okay.
Chapter 12, the income approach. See, that's why I couldn't do voices or anything, it's because he would laugh at me. Chapter 12, the income approach, income and expense analysis. The income approach converts all expected future net benefits into an expression of present value. It is frequently referred to as the income capitalization approach. The capitalization process converts the expected future net benefits of property ownership into an expression of present value. The buyer of a single-family residence makes the purchase in order to enjoy the benefits the property will afford in the future. Likewise, the buyer of an investment property pays the price in order to receive future benefits, the annual income stream generated by rents. As in the case of the cost and sales comparison approaches to value, the principle of substitution applies. A buyer will not pay more than the amount required to obtain a substitute property, providing a similar return on the investment. The cost approach, the sales comparison approach, and the income approach are not intended to be independent of each other. Rather, the three approaches are interrelated and interconnected, and they rely on data from the same market. Techniques and procedures from the income approach are used to analyze comparable sales in the sales comparison approach and to adjust for obsolescence in the cost approach. There's that word, obsolescence. The assessor must be familiar with the income approach to value for several reasons, among which are the following. When no reliable sales data are available for the appraisal of a property, for instance a commercial property, and the building is old and the cost approach inconclusive or unconvincing, the income approach may be the best value indicator. Typically, owners of income-producing properties rely primarily on the income approach in making decisions to buy and sell. The income approach is a valid check on the value indicators provided by the cost and sales comparison approaches to value. The property assessment statutes in most states require the assessor to consider all factors that affect market value. The basic steps in income approach are as follows. Number 1, estimate potential gross income. Number 2, deduct for vacancy and collection loss. Number 3, add miscellaneous income to determine the effective gross income. Number 4, estimate operating expenses. Number 5, deduct operating expenses from the effective gross income to determine net operating income before return on investment, recapture, return of capital, and taxes. Number 6, select the appropriate capitalization rate. Number 7, determine the appropriate capitalization procedure to be used. Number 8, capitalize the net operating income into an estimated property value. This chapter discusses the first 5 steps in this process. Steps 6, 7, and 8 are discussed in Chapter 13, the income approach, capitalization formulas, and rates. This chapter covers income and expense analysis, which is a necessary step in arriving at a net operating income for the property. Note that the income and expenses proper and acceptable for income tax purposes are not necessarily the same as those appropriate for the income approach. Only the reasonable and typical expenses necessary to support and maintain the income-producing capacity of the property should be allowed. This is important because the investor is interested in both short-term and long-term profits. Even though the taxable income for any given period may or may not be related to the real estate value in question. The appraiser must be familiar with several terms in estimating the appropriate rent involved in a market value appraisal. Two of these terms are economic rent and contract rent. Economic rent, also known as market rent, is the most probable rent that a property should bring in a competitive market, as justified on the basis of an analysis of comparable rental properties. Market rent is used as the basis of income estimate in the income approach because it is the rent expected by the market for the property on the basis of comparable rental properties in the area. Contract rent is the rent required to be paid by the tenant under the terms of the lease. It is the rent stipulated in the lease agreement. Contract rent may be higher or lower than the market rent. In some circumstances, the appraiser may encounter governmentally imposed rent controls or other income restrictions such as rate of return limitations or tariff restrictions. When appraising properties under income restrictions, the appraiser should consider the estimate of market value based upon the income expected for the property subject to those restrictions. This is similar to an appraiser considering the effect of zoning regulations with the attendant limitations and restrictions applicable to the property. Failure to consider the impact of these limitations or restrictions might result in an erroneous market value indicator.
Or an incorrect answer on a test, maybe.
That could happen too. Gross income estates.
Estates?
Estimates.
That word is very big.
The word is very big. So, gross income estimates. The first step in the income approach to value is to estimate the potential gross income for the property in question. Potential gross income is annual market rent for the property at 100% occupancy. Market rent is the annual rent that is justified for the property on the basis of a careful study of comparable properties in the area. In other words, market rent actually includes income from all sources that may be attributable to real estate. For example, a retail store that has 3,000 square feet rents for $75 per square foot per year. Assuming that $75 per square foot per year is market rent, the potential gross income can be computed as follows. 3,000 square feet multiplied by $75 per square foot equals $225,000 potential gross income. The potential gross income for this property is the annual market rent of $75 per square foot times the number of square feet, 3,000, which equals $225,000, or the maximum possible annual rent the property could produce if rented at market rent and if fully occupied. The rent that a property commands in the market depends on the many different factors. Just as the assessor must examine all the terms and conditions surrounding the sale of the property when the sales comparison approach to value is used, so all the circumstances surrounding the comparable rentals used as a basis for establishing market rent for the subject property must be examined in the income approach to value. Rental information sources. In searching for comparable rental properties, many of the sources used in the sales comparison approach may be considered. Typical sources of rental information are buyers and sellers of commercial property, commercial property managers, realtors, tenants, and public records. A professional relationship should be developed with these information sources. This relationship can be established by making requests for information in a reasonable manner, by explaining the need for and purpose of the information, and by maintaining the confidentiality of all information received. Rental market data. Leases. Rental information may be recorded on leases that are a matter of public record. Leases ordinarily detail the terms and other important considerations between tenant and the property owner. Listed below are various types of leases. Leases found in the marketplace may be a combination of two or more of these various types of leases. Month-to-month lease. Month-to-month leases are short-term leases that may or may not be in written form.
Why don't you read that sentence over?
Okay. Month-to-month leases are short-term leases that may or may not be in written form. This type of lease provides no security for the tenant or the landlord because the landlord has no guarantee of future occupancy and rent payment, and the tenant has no guarantee of the right to continue to occupy the premises. Short-term lease. Short-term leases are generally written with the terms and provisions of the lease detailed. Usually, a short-term lease is considered to be for a period of less than 5 years. Long-term lease. The long-term lease provides for terms extending more than 5 years. Percentage lease. Percentage leases typically provide for rent payments to be based on percentages of income from the sale of merchandise or services. Percentage leases frequently have a stated minimum base rent plus an overage rental amount. The overage rent is the percentage rent paid above the guaranteed minimum base rent. Sometimes a percentage lease contract specifies a maximum rent provision. Graduated lease. The graduated lease provides for a stated rent level for a given period, followed by a charge, usually an increase, in the rent level during a stated subsequent period. Renewal lease. Renewal leases provide for one or more extension of the lease term in the original lease document at the option of the tenant. The rent under such renewals may be predetermined or negotiated at the time of renewal. Comparison among leases. In comparing one rental property with another, the following factors are considered. 1. Effective date of lease. 2. Location of property. 3. Physical characteristics of property. And 4. Terms of the lease. By analyzing these factors thoroughly, the assessor can determine the comparability of the rental properties. Because the income approach depends upon the accurate...
Hold it. Okay, go.
Comparison among leases.
Is that where you left off?
Yes. In comparing one rental property with another, the following factors are considered. 1. Effective date of lease. 2. Location of property. 3. Physical characteristics of property. And 4. Terms of the lease. By analyzing these factors thoroughly, the assessor can determine the comparability of the rental properties. Because the income approach depends upon the accurate estimate of market rent, the leases covering the subject property as well as those covering comparables in the area must be carefully analyzed. The following considerations provide helpful guidelines for comparing leased properties. This is a gigantic list. Phew. Date of lease. As with the date of the sale in the sales comparison approach, the effective date of the lease must be known. The beginning date of the lease term is the significant date for the comparison and analysis purposes in the income approach. Leases negotiated several years earlier may not adequately reflect current prevailing conditions, and the rents paid may not be indicative of current market rent. Name of the owner, landlord or lessor. The owner, lessor, is the party who receives the rent. Name of the tenant, lessee. The tenant, the lessee, is the party who occupies the premises and pays the rent. What is going on over there?
Go.
Reference. The reference indicates where the lease is recorded. Legal description. The legal description or other identification may include a parcel identifier and property address. Lease term. The lease term should state the beginning and ending dates for the tenant's occupancy. The number of months and the years remaining and covered by the lease can thereby be calculated. Amount of rent. The lease should contain a clause stating the amount of rent, how and when the rent is to be paid, and whether or not any percentage, graduations, or overages are applicable. Owner's responsibilities. Statements in the lease specify the owner's responsibility for maintenance, insurance, taxes, and other items during the terms of the lease. Tenant's responsibilities. Statements in the lease relate to the tenant's responsibilities for taxes, insurance, utilities, maintenance, and other items. Lease provisions may call for an escalation of rent payments due to an increase in the cost of these items. Taxes. The tenant may pay all of the taxes, part of the taxes based on the lease terms, or none of the taxes. right to sublease or assign. There should be a clause stating whether the tenant may assign or sublease the premise and under what conditions. This statement should also indicate whether an assignment or sublease This statement should also indicate whether an assignment or a sublease would relieve the initial tenant from future responsibility under the original lease. Option to renew. This clause should give dates, terms, rent payments, and other provisions specified as the tenant's option. Tenant improvements. This clause should state the condition under which the tenant can make improvements to the property being leased and whether the improvements are to remain or can be removed by the tenant at the end of the lease. The responsibility of the tenant for taxes on improvements should also be stated. Security. The provision should state the amount of the damage deposit required along with the advanced rent. This clause should also include a provision for damage claims that result from tenant abuse to the property. Termination. This clause should indicate under what conditions the owner or the tenant can terminate the lease. Special provisions. This clause should include other special conditions or considerations that would have an effect on the tenant or the owner of the property during the term of the lease. In analyzing leases and interviewing owners and managers, the assessor may come across such terms as gross lease, net lease, net lease, and net lease.
Yeah, I remember that. Triple net lease is what the text refers to.
Okay. Although each term has somewhat different meaning to different individuals, the most common understanding is that a gross lease provides for the landlord to pay all maintenance, utilities, insurance, and taxes. The triple net lease provides for tenant to pay all property expenses. Net leases and double net leases are degrees between the gross lease and the triple net lease and may require specific expenses to be paid by either tenant or landlord.
Yeah. Believe it or not, I kind of remember that from the class for some reason.
That's good.
Weird.
Other types of rent. The various types of rent are as follows. Contract rent, the actual amount of rent per unit of time that is specified on the contract, the lease. Excess rent, the difference between contract rent and market rent that occurs when contract rent exceeds economic rent. Deficit rent, the difference between contract rent and market rent that occurs when the contract rent exceeds economic rent. Did I just read that?
No. Well, we'll read it over again. Deficit rent.
Okay, I didn't read it correctly. Okay, deficit rent, the difference between market rent and contract rent that occurs when the market rent exceeds contract rent, resulting in a positive leasehold estate. Percentage rent, based on a fixed or graduated percentage of gross sales, normally with a guaranteed minimum base rent. Minimum rent, the base or fixed rent provided for in a percentage lease. Overage rent, rent over and above a guaranteed minimum under the terms of a percentage lease, not to be confused with excess rent. Market rent, the rent currently prevailing in the market for properties comparable to the subject property. Market rent is capitalized into an estimate of value in the income approach. Rental units of comparison. If the rent from a property is to be considered in relation to property value, the rent should be expressed in terms of some common denominator. An appropriate unit of comparison should be selected. Several common units of comparison are used for the various types of income-producing properties: square foot, rooms, apartment units, space, and percentage of gross business income of the tenant. Table 12.1 lists the rental units of comparison and their applicability to various income-producing properties. Are we reading this or no?
Yeah.
Okay. Table 12.1. Units of comparison for income-producing properties. Rental unit of comparison, square foot. Type of income-producing property, shopping centers, retail stores, office buildings, warehouses, apartments, and leased land. Rental unit of comparison, rooms. Type of income-producing property, apartment buildings, motels, and hotels. rental unit of comparison, apartment units, type of income producing property, apartment buildings, rental unit of comparison space, type of income producing property, mobile home parks, travel trailer parks, and parking garages, rental unit of comparison, percentage of gross business income, type of income producing property, retail stores, shopping centers, restaurants, and gas stations, rental unit of comparison, gross income multiplier, type of income producing property, apartment buildings, and commercial offices. When the square foot unit is used with an office building or a shopping center, care must be exercised in the comparison process, because some leases refer to gross leasable area, or GLA, and others are negotiated on the basis of net leasable area, the NLA. The GLA includes common areas such as halls, restrooms, and vestibules. The NLA includes only the floor area occupied by the tenant. An office building with 100,000 square feet of GLA might have an NLA of only 80,000 square feet, which is a difference of 20%. When leases are compared, the assessor must know whether rent is based on GLA or NLA and what method is used to determine the NLA. The gross income multiplier, the GIM, sometimes called the gross rent multiplier, GRM, is often used to compare commercial and apartment properties.
Oh, they're making GIM and GRM synonymous here. Huh, okay.
The GIM is derived by dividing the sale price of a property by its annual gross income. The GIM can be developed either on a potential gross income basis or an effective gross income basis. If developed from effective gross income, it is called the effective gross income multiplier, the EGIM. Either way, it is acceptable as long as it is used in the same manner in which it was developed. The GIM can also be used to develop a value opinion for the subject property simply by multiplying the subject's potential gross income or effective gross income by the appropriate GIM or EGIM. Rental units of comparison can be expressed in terms of rent per month or rent per year. Local custom and the type of income property determine whether typical rent is specified per month or per year. The important consideration is to avoid comparing rent per month with rent per year. In the capitalization process, income and expenses, as well as capitalization and discount rates, are expressed on an annual basis. You have a marker to end.
Yeah, we can keep going.
Keep going?
Yeah. Hold it.
Bye.